Principles of Finance, a la shmup. Operational Metrical Analysis. You skimmed through the revenue summary lines a few videos back. The focus now is on expenses. They tell a story, and in some cases, they help define a company. For example, the battery intellectual property behind Blade Runner was a huge part of its story to the street. The fact that the company made its own, at scale, better and cheaper batteries than the competition, well, that was a big part of the reason it won the early battles of drone wars in a galaxy nearby. So you go through this thing line by line again with an expense focus. Well, it's really just a bunch of random observations here. This spreadsheet's almost all you know about the company at this moment in time, and a few powerful trends are sticking out at you. First, the batteries charger systems are going down in cost pretty steadily for the first few years here. Then it looks like they've flattened out at $30-ish in the last 3 years. Well, why have they flattened at $30? Is it a scale issue? Like if they produce 10 million batteries a year, i.e. sold them to everyone else, all their competitors as well, and every other drone maker, maybe even beyond drones, would their costs then go down to $20 or $15, or have they hit their maximum cheapest price they can make at scale here? You note to ask that question to the company management if you're ever able to get a real meeting. Well, the form factor plastics costs have continued to decline steadily. You wonder about the aftermarket market. That is there a business selling broken blade replacements at $3 each? They can't cost more than a nickel each to make it scale. And then there's another weird thing you wrestle with here. The company really makes two products. This model breaks out the revenues separately, but not the costs. Why? Is there maybe just one factory that does everything now and then the parts get parceled out? The more you think about it, that's got to be how it's done, and it would explain the very high depreciation and amortization costs being run through the income statement that you can't point to otherwise. Well, they probably built a big factory to do this when times were good, and now it's, depreciation time. The plastics thing is an interesting nugget here, in that the unit cost went from $52 plus down to about $40 a year in 5 years. That's $12 more of margin per unit for a pretty small element here. You wonder how much cheaper the plastics part could even get. Then there's the camera costs. Yeah, these have clearly followed the computer technology cost curve, with massive declines in cost, going from about $60 a unit in 2018 to $38 just 5 years later. Well, you wonder if the trend will continue, and you remember your grandfather's speech about the $499 Hewlett-Packard calculator that today is a $1 throw-in at the airport checkout stand. It literally costs less than the big Twix bar packet next to it. Will video cameras go the same route, you wonder? Well, the guidance system numbers must belie things. That is, the costs go from $109 to $92 each. Nice steady but slow unit cost declines. But you know that the complexity of guidance systems grew geometrically with massive government regulation all around the world. Everything today has to be licensed and is carefully regulated, and the owners, in order to get to fly the drone, have to personally authenticate and identify themselves biometrically on the machines or they won't fly. Well, if the circuit isn't completed with the FAA and the thumbprints and eyeball retina and all that stuff don't match, well, then that day is a no-fly day. You note to yourself that this technology and all the lawyering behind it couldn't have been cheap. So the fact that the costs went down at all is actually surprising to the upside. You're guessing that the cost of the hardware and the software licenses cratered, while other costs like adding in biometrics made the declines much slower. If that's the case, well, then in the next few years from here, costs should come down fast on the new guidance system with no more upgrades needed. Okay, so now you move down past the per unit expenses lines there into the overall, and a bunch of rough numbers map into your head to the 425 million-ish revenue figure you're averaging out from the recent last few years of operations. Well, the quick summary: who cares about batteries, form factors, cameras, and packaging shipping? All of them together are barely over $10 million in expenses overall. Even if you could reduce them a whopping 40%, well, they don't really move the bottom or top line much. So this just simplified a whole lot of your early due diligence on the company. You can pretty much ignore these line items for your initial walkthrough, especially with management. Guidance systems, yeah, they matter more, but interesting, the overall cost there is flat. You're guessing that the company had a migration away from the bigger, more expensive drones to the smaller ones in the later years, and the guidance guidance system basically was the same whether the drone itself was big or small. Well, the big cost here, yeah, labor. It's magically flat at this weird $89 million-ish number. It's amazing how they came out to the exact same amount of labor costs year after year, to the dollar even. Go figure. Same deal with packaging and shipping. What are the odds? Anyway, labor is a biggie here. You wonder why it didn't scale, meaning get cheaper with volume and time and size. That is, you'd think that a robot-y company would take advantage of robots in assembling these things. Why wouldn't the assembly labor costs go down? And you think about it qualitatively in that labor is about a fourth or a fifth of the total expenses behind these drones. That seems really high in the scheme of things. You wonder if there's some wizard-like value add you could bring in here to stem the cost of labor, and you're wondering about unions, and you got to ask about those contracts and what's going on there. The whole notion of value add here for you coming into this company is a biggie with any of the really expensive private money management firms. The sell to the investors putting money into the private equity funds is that management are knuckleheads, and that the real genius kids from Stanford's engineering and computer science departments will know better how to make the rubber hit the road, or the blades hit the oxygen molecules, as it were. Yeah, it works. Lots of 2% fees get paid on the backs of Stanford PhDs. Anyway, if you look at the total expenses line, it hovers like a drone, strikingly flat in the mid to high 170s zone, even though pretty volatile revenue moves are here. Is there just a basic fixed recurring cost to this company that they're wedded to and they can't get away from? Like a minimum amount of inventory that just has to be ordered for the trains to keep on training? Well, ordinarily it wouldn't make any sense in a company like this. There are in fact marginal expenses to building this product. The opposite would be like a cloud management company who has almost no marginal expense other than electricity to run its huge clouds of servers. Well, gross margin here at the drone company moved all over the place, very much a tail wagged by the revenue dog, from 48% in 2018 to almost 60% in the later years. When the company really started to struggle, well, then something seems really off. If things were going badly, wouldn't you expect gross margin to decline? Why would it go up? Makes no sense. All right, well, maybe things will start to click more here after her 14th cup of coffee.